Hello, everyone, and welcome to the Upside Ticker Talk, episode 11. Today is April 15th. Spring's finally starting to roll around, albeit it is quite miserable outside here in Montreal, but I think everybody's quite excited about good things to come. Turn of the seasons. Great first quarter for the Canadian ETF industry. The Montreal Canadiens are back in the playoffs. Selfishly, I'm very excited about that, as well as golf season coming around. But we're very happy to be back recording today, and we've got a really unique and special episode to bring to you. We've got two guests coming to join us, which I'll introduce shortly. But before we go ahead and do that, as usual, just a quick recap of our last episode. I had the pleasure of hosting Frédéric Viger from National Bank, where we talked all things market making. We also had the chance to talk about Fred's, best practices for trading ETFs, what's been popular industry, what might be coming around, and a bunch more. And you can find that on your favorite podcast app, YouTube, or wherever you consume this content. Before I introduce our guests, since we have a bit of a different structure today, usually we involve the guest in kind of the industry trends and all that stuff. I'll spare them that, and I'll go ahead and run through the highlights from March by myself and maybe provide some quick commentary. So without further ado, I mentioned that we're off to a really hot start. Well, the first quarter of the year here, we've actually seen a significantly outsized record quarter with a total of $60 billion. That was wrapped up, I guess, if you will, in March with about $19 billion in net new assets coming into the Canadian ETF industry. So way ahead of Q4 of 2025, which was the previous record. Some of the notable highlights and headlines that I had noted down here. Well, first of all, good month in March, considering the volatility that we saw, considering also in Canada, it's the end of RSP season. It's generally a slower period for the industry as a whole. I think coming in at 19 billion was quite impressive. To give a perspective just on how great of a quarter it was. Last year was a record year at $165 billion in net new assets, and we're already at 60 3 months in. So it's kind of, if we continue on a similar path or even slight slowdown, I'm guessing we're going to have another record on our hands in 2026. In terms of highlights for the month, equities continued to lead the way, 12 billion for the month. That was led by international equities, which also includes global mandates at around 5 billion. Interestingly, also, Canadian equities are outselling U.S. equities this year, and that was mainly due to March, where there was a 600 million more of inflows into Canadian equity ETFs than U.S. equity ETFs. So that's kind of an interesting one as well, right? The Canadian market seemingly working better also than the U.S. market this year. Definitely more exposure to some of the commodity space, which is seen obvious price increases over the last month due to the ongoing conflict in Iran. Speaking of commodities, they slowed down a lot in March, albeit there was demand for oil ETFs and also some daily daily reset leverage ETFs. Only 20 million of inflows for the month. If we look at the first 2 months, it was about $1.2 billion in inflows. So really basically coming to a halt in March. And that was mainly due to outflows in gold and silver ETFs, which we saw outflows for the first time in a very long time. I mentioned daily reset and levered inverse ETFs. Really strong month at 750 million. And I think, some of that obviously is due to the volatility that we saw. I think investors and our advisors trying to participate in these very high very high volatility days where you have, outsized upside, outsized downside. So a bit of a higher volatility period that we saw during March. I'm sure, probably some winners and losers. And I will say, though, that, these are tools and investment vehicles that are probably, you have to be careful when using them for longer investment horizons, but can definitely be useful tools for trying to participate on daily swings. Other key notes that I have here, value factor ETFs were very popular during the month. Total of $400 million, notably led by one of our ETFs, Fidelity International Value ETF, which aims to purchase around 100 international developed equities focused on companies that trade at attractive valuations based off of metrics like free cash flow yield, EV to EBITDA, price to tangible book, forward PE, and among some of the most important there. And if you look at the exposure that you're getting in that product specifically, It's done really well for a few reasons, notably the sector allocation shifts. If you're looking at value areas in the international developed markets, you were overweight to things like financials, was done really well over the last 12 to 16 months. You've also had exposure to overweights to utilities, to industrials, materials, all sectors that have outperformed the broad market there on the international side. So definitely benefiting from some strong performance tailwinds, but seemingly also favorably positioned currently as we have ongoing fears from an inflation standpoint, potentially moving to rate hike cycles going, Bank of England as well as the European Central Bank. So generally the value factor is actually a bit more resistant in an inflationary environment where growth seemingly is hit a little bit as discount rates go up. So interesting story to be seen there and see if that continues. And lastly, the last point I had was on multi-asset ETFs. They continue to chug along with about 1.6 billion in the month of March. That category is positive every single month, and it seems like it's continuing to accelerate. Obviously, our all-in-one ETFs, which is going to be the main focus of our conversation today. So I won't dive too much into that, but that category is seeing a lot of inflows for sure. So with that, I'll wrap it up, and I'll welcome our guests to join us. So I mentioned this is going to be a very interesting and unique episode, and I'm very excited to welcome two individuals today that I've had the chance to meet a couple times over the past 6 months, Régis and Anthony Holstein. These two gentlemen are responsible for the subreddit JustBuyFEQT. So big fans of our all-in-one ETF lineup, Fidelity all-in-one equity in particular. They've built a community of investors that follow and a lot of them probably invest as well in FEQT. That's on Reddit, that lives there and now has more than 500 subscribers, 1,000 daily visitors per day. So quite an accomplishment, and obviously, a ton of respect from our side doing all that work because, a lot of this stuff that you'll find on that page is really educational and really interesting for somebody trying to learn more about those products. So thank you guys and welcome to the show. It's great to do this.
Thank you so much. Well, we're thrilled to be here today. Thanks for having us.
Thanks for having us.
Yes.
Yeah, no, this is going to be fun. And usually what we do is like I have a guest and I ask a lot of the questions. So I guess I'll give you guys the chance to ask me some questions. We'll flip that around a little bit. But we always do the Asking the Internet segment in the show. We just decided to bring the internet to us today. So that's very interesting.
We are the internet.
You are the representatives of the internet today. So I guess before I'll throw it over to you guys. I've got a few questions for you. So I'm still going to do my little moderating job and I'll ask you guys a few questions because I have a bunch, and the first one is just, tell us a bit about yourselves. Like, how did you guys get into investing?
I will start. So I'm Anthony, a 20-year-old engineering student, and I started my investing journey back in December 2023 as I was receiving scholarships from the Quebec government, studying in a sector with labor shortage, and that money was, sleeping in my bank account, and I had to learn how to invest, and that's when I invested my money, and I eventually discovered FEQT. And this is something I really liked because of its active management aspect, as well as its factor-based approach. And it matches my investing methodology, philosophy, and I'm particularly into space companies and everything, so really niche, and having a fund that is active managed and that's in a particular sector, invest in some sectors when there is some momentum, when there's some value, quality in some companies, instead of a passive approach where you have companies all ranked depending on their value. This is really something that I really liked about FEQT, in that I've been investing in it since I think started my journey in 2023. So
awesome.
Really
It's
cool.
2023, so fairly new still, but I mean that's great. It's really interesting. What about you, Régis?
Yeah. Well, my name is Régis. Yes, I'm a solopreneur in the translation industry, and actually I started investment very late. I started in 24.
Oh, really? After Anthony?
Anthony.
So he convinced you, not the other way around.
That's right.
He's actually the catalyst. He's the one who actually motivated me to say, hey, what are you doing? So, I started to dig on the web, starting on social networks. And then I said, well, how can I get started? So I said, okay, maybe I should do some stock picking. And I was not really convinced because you have to know what
It's
you're
not
doing.
easy. It's not easy to do.
You have to know when to buy, when to sell, and I had no clue.
Yeah.
So some people told me, well, go with the passive, all-in-ones. I said, yeah, well, everybody's doing that almost. I mean, it's, I want to do something different, I want to do maybe something better. So then I found factor investing online by digging through the web, and Fidelity in particular. And then I said, well, that's pretty nice, but I don't know actually which factor I should buy, momentum, value, and when should I buy, and when does it cycle? And then I said, well, there's an all-in-one, FEQT. This one, actually, it's all the factors at once, plus a little bit of Bitcoin. I said, well, maybe that's my guy.
Okay, interesting.
So that's actually when I started with, actually, FEQT is actually more than 3/4 of my portfolio now.
Wow, awesome. I guess you guys kind of touched on it a little bit. Like my second question was going to be kind of what got you interested in FEQT. And I guess from the sound of it, a lot of it has to do with kind of the factor approach, which I'm sure you guys got a few questions around that for me. But in the sense that like it stood out because of that factor approach, I'm guessing, to you guys, and being, a bit different.
Absolutely. And actually what we enjoy to do is when you do the rebalancing, so I think it's every quarter for momentum, every semester for the other factors, we really like to actually dig into those ETFs and look at the movements, which actually tickers have been removed, which ones have you added,
and how much it has changed from the past rebalancing.
Exactly. So, and we really like that because actually it really follows the state of the market, right?
Yeah.
Sometimes you have there's like a cycle shift from, let's say, one group of tickers to another one. Let's say moving maybe to miners or moving away from technology, and actually the different factors are actually following those movements. So it's really fascinating. We really feel connected to actually the markets.
Interesting.
Yeah.
Well, why am I here? I mean, you guys are doing a great job just describing the product and its advantages already. I don't need to be here. You guys could just do this by yourself. So I guess going from there, obviously it's one thing to, be interested in the product and believe in it, and you start allocating money to it and all that, and that's great. What made you go to the next step and say, we want to build a little community around this, and decide to create a Reddit thread? Was it we were doing a poor job, giving information out, or so how did that come about?
Actually, no, you are doing an amazing job at Fidelity, but we wanted to really put the spotlight on how FEQT works, and we really tried to understand how the algorithm works, why this particular stock is moving up, the other one is moving down from a rebalancing to another. And we really wanted to make this transparent and share it to everyone on Reddit and our community, and make FEQT known to more investors.
Yeah, and your web pages are really nice. I mean, you're putting a lot of information, and what we wanted actually is to take it from there and make it even more actually, I would say verbose and explanatory to newcomers, especially people who don't really know, investing. Yeah, and most of those people, they are following trends. So maybe they are buying, this EQT or that EQT, but they maybe just skip FEQT because they don't really understand it. Yeah. And what we enjoy to do is basically, and that's something that people are requesting every rebalancing that you're doing. We basically take all the underlying factors of FEQT, we open them up. We actually take
a lot of work.
All the tickers. A lot of work. We rank all the tickers. We remove the duplicates. We make like a very nice table. And then we publish it, and then people can see, NVIDIA now is actually moving a little bit down, and this one's moving up. And there's, let's say, that company actually with the passive ETFs, they are like ranked 600, but because of your factors, they are ranked 20. Yeah. Well, that makes a difference in the way that the
for sure.
The
that's
ETF
what drives performance, right? Like having
right. And so that's basically what we want people to see is actually, your approach makes a difference. It's really different.
Yeah.
And awesome. It takes us maybe a weekend, but it's worth it because as investors, you try to really understand what you're investing into. And I'm new to investing, but really digging into FEQT helped me a lot, like understand how an ETF works. Right. And it helped me with understanding the products I'm investing into.
Sure.
Yeah.
Yeah, for sure. Anytime you're doing like research, regardless of the level or depth that you go into, is like you're going to learn new things. So definitely a good practice just to, whether it's looking at different sector changes, looking at different underlying holding changes, you're going to see why certain things happen with a factor. The great thing about factors, and once again, I'm sure we're going to get into it, but it's black and white. It's written on paper what we're like. The reason a company's moving in or out of the portfolio or going up or down in size in the portfolios is all tied to math, right? It's a rule. It's a methodology. So I think there's something definitely to take out of that. I guess my last question I have for you guys is, what's your personal favorite feature of FEQT? And could be very short answer. It could be but like or longer. But what's your favorite feature? And I don't know if there is one. And it's okay if you say there is not one, and that's kind of that's the nice a nice easy answer. But
I have two. I can choose between both, but the two I really like is first the structure. For all the regions, you have momentum, value, high quality, and
low vol.
Yeah, and particularly the high quality factor, because my approach is I do have a volatile portfolio investing in some
more speculative names,
and I have like FEQT to balance my portfolio, so I can like reduce my volatility, and I always aim to like rebalance everything into FEQT down the road. And my approach is always like to invest in higher quality company, and the quality factor inside FEQT help me.
So it matches kind of your own style, if you will, being in there. Okay, I like that. That's awesome.
Yeah. What I like actually is, I think crypto is something that you cannot really do without nowadays. It's some people like it. It's very polarizing. People like it or people dislike it, and they either want it or don't want it in their portfolio.
Yeah.
I think it's interesting. I wouldn't actually buy it like on its own because I don't want to manage it. I think it's very tricky to manage. You have to really, I don't know, if it's going down or higher in the long term. It's very speculative.
There's also the tax aspect.
And the tax aspect. So what I liked here is that there's 3% allocation, for example, in FEQT, and you guys are the expert to manage it. So I don't have to worry about it.
That's fair.
If you see that Bitcoin is actually it's really getting really bad and trouble, I'm sure eventually you'll do something about it in the FEQT, right?
Yeah.
So I don't really have to care about it, but it's there. So it's doing it's actually doing its thing. It's pulling up. Maybe sometimes it's pulling a little bit down, but it's doing its thing.
Yeah.
So, but I don't manage it.
Okay. And it's the intention of having that in there is from a diversification perspective, and obviously, I don't know, you don't know, nobody really knows what to establish a target value for something like a cryptocurrency like Bitcoin is almost impossible. I mean, maybe some will claim that they know, but I haven't found that person yet that is absolutely right. And to your point of like not having to manage it, it's not so much like the actual like buying, storing, like getting your own cold storage, putting it to the side, not forgetting your password, not that, like that's one thing. But the other thing is more managing your emotions and behavior because it's so speculative. Because when it's up, like, everybody's like, I want more Bitcoin. And then when it's down, it's like, everybody's like, this is going to zero. Right. And so
this is the end.
It's always, it's going to 1 million or it's going to zero. And so in our approach, obviously the way that we rebalance the portfolios is like every day that it's down, we're generally allocating inflows to it. And so we're really counterintuitively, making sure that we're not doing that. Intuitively, making sure that we're not succumbing to that emotion. Right.
Yeah.
So
Exactly. And actually, the reason why I'm into FEQT long term is because I don't want to deal with emotions, right? I just invest. It's investing, so I just put money regularly into it, and over the long term, it will do its job. But if I had Bitcoin, I would have to deal. Now it's really all-time high. Maybe I should sell some to actually lock some gains. Yeah. Or if they're going down, maybe I should put some money just in case it goes back up.
FEQT is just.
So, but you keep just moving things around, drip. I just want to be like a passive type of investor, but actually you're doing the active in the background, right?
That's a wise man once said it's not about timing the market, it's time in the market, right? So I think that's kind of the idea, I think, with an FEQT like solution. All right, guys, well, that was the only questions I had for you. So I mean, now's your time to grill me. It's my time to answer the questions, and it's a bit different. Usually I always take a step back in these because I do so much talking every day that like this podcast is usually my escape, but not today. I'm not escaping today. So fire away. I mean, I know you guys had a list of questions, so let's get to it.
We have questions actually that we gathered from the JustBuyFEQT community.
Oh, awesome. Perfect.
So they have
everybody's in
very
on this.
interesting question.
The internet is here today.
Absolutely.
Awesome.
I'll let you get started on that.
The first question one Redditor asked is, how does FEQT differentiate itself structurally from competitors?
Yeah, that's a great question. I think, I mean, we've already touched on a few of these, obviously. And the number one thing being is, our approach is centered around, factor-based investing. But at the end of the day, like what that is, to simplify it even for everyone, is like the global investment universe, as much on the equity as on the bond side, is immense. Like more than 25,000 traded securities. And then so, we looked at what a lot of the competitors were doing is saying, let's just buy everything. Right. And, that'll get you from point A to point B, and it does. Our idea with factor investing, like you would with like a sift or like a filter, is to try and say we can get a sample of the global market, but ideally we can remove, those securities that don't have a defined investment thesis. And it doesn't mean that a good value name is automatically a good quality name, but it's that we're getting exposure to, these characteristics that over the long term have shown to add value. And so by doing that, we're inherently basically like getting the top decile, like the top 10% of that 20 in our minds. And we're not always going to, like, we're not trying to pick the 2,500 best, but it's easier for us to remove, say, the 15, 20,000 worst, or those that we think have less probability of being
keep the best
outcome.
for FEQT.
Exactly. And that's really the idea. So if you look at it just like, if you, and you guys have done the exercise, if you like take every individual ETF in FEQT and you open that up to see how many securities we have, it's about like 20. It's actually less for FEQT. It's going to be less than 2,000. Whereas like a lot of the competitors will be up in the like 5, 10, 15,000 types of holdings. So that's one of the structural differences we have. That hopefully is how we generate our excess return. The other one, to your favorite characteristic being, definitely having an allocation to cryptocurrency is different. I'd say also the inclusion. So we have the factor side, but also the inclusion of active management. So for things like small caps, where it's a very kind of muddy market, if you will, it's a lot less transparent. Companies, their reporting is much more variable. Like a small cap company can go from being very profitable to not profitable in a quarter. Yeah. Right. Like, so in the sense that having active management in a space like that, I think sets us apart from competitors that might use, small or mid cap indices where things can change fairly drastically. So those are, I'd say, the main ones. And then there's probably a bunch of others, but those are the ones I'd focus on.
Nice.
Yeah.
Do you guys have any plans to add multi-alts like long and short funds, global small mid caps like FGSM or emerging markets? I think it's a question that we were asked.
Yeah, no, that's a great question. And like even taking a step back, kind of the process of how we manage FEQT is obviously like we're not trying to play around with it too much. Because I think what we've constructed and what we've designed, has done what we intended it to do. And so anytime we consider adding or removing something, is this for the betterment of the portfolio? And ideally, like the things we've added, hopefully we don't want to be removing them, but there may come a time and place where that is necessary. But in terms of adding kind of these other areas that aren't present in the portfolio, I'd say for the global small mid, I think for now anyways, it's addressed with our global small cap opportunities ETF that we have in the portfolio. So that one I'd say is pretty definitive. Like right now, I think we're good there. For emerging markets, that's one that we've asked ourselves many times. The reality is it's kind of the same explanation that I gave for small caps, in that we don't really ever want to be allocating to a passive emerging market index because of, the average quality of a business in the emerging markets index is significantly lower than, say, the Russell 1000 or the S&P 500. And so we'd ideally like to have an active manager to do that. Right now we don't have that tool at our disposal, but it does not mean that we won't. And that's something I think that's probably, it's going to be up for consideration in the future. And then, what was the last one? So it's just for emerging markets, small caps,
and long and short.
Long short. So alts is another great one, right? So I think alts, and this is something, that we definitely take into consideration, not just because of like the world that we're in now, but just generally speaking, like we want to be competitive on cost. And if you look at, some of those strategies are a bit higher up in the cost spectrum, and for kind of like a core strategic mix, like we don't really see the immediate need right now, but it's something that if correlations start to get, if fixed income and equities start to correlate together, that's an option that's available to us. We do have a number of liquid alternative ETFs available as standalones, and actually to a point where if somebody's looking for maybe a bit more of a downside protection, you can pair an FEQT as well as one of those products to the side. But then to add it to like the core mix of FEQT, I think we're not quite there yet. Let's just say, especially for the EQT. I think if we do add them, it'd probably be in the all-in-one balance or all-in-one conservative, and maybe the more down, the ones that have more fixed income, and remove maybe some of that fixed income.
And there's a really related question, I guess. We were asked also if you guys were planning to eventually add gold to the mix.
So that's a really interesting. It's easy to say once you've had a 3-year bull run in gold. No, but it's an interesting one. I think gold and our approach has been we'd focused on Bitcoin, which and it's not to say that it's like a digital gold. It's not really. It hasn't really played out that way, anyways, for the most part. Actually, recently a little bit, but not. Historically that wasn't the objective for our Bitcoin allocation. But I will say gold's a really interesting one. In our current framework, when we kind of played around with it, it didn't seem like it was very additive to the actual portfolio, in the sense that like we were getting the diversification benefits we needed with Bitcoin, as well as some of our other active components that we didn't see the need. Once again, that's another one that like in the future that could be an option. Obviously, gold prices are once again like, and anytime we add or remove something from a portfolio, it's not a timely thing. Yeah. Like if we do decide, down the line we're going to look to add gold, it wouldn't be because we're trying to say gold's going up. It's just be, structurally this makes sense. Looking at a longer sample of like calendar years, 15, 20 years, gold makes sense. And it's not to say that it wouldn't. It's just for now we've kind of set that to the side. But once again, like it's something that I add on to the other holdings that I have, including FEQT, which I'm also a shareholder of. Obviously, I mean it'd be pretty tough to have you guys on if I wouldn't own some myself. But yeah, so that's kind of the approach, the thinking. It's always long-term thinking anytime we do. Yeah.
Interesting. Next question. What have been the top contributors and detractors to FEQT's performance over the past 12 to 24 months?
Yeah, that's a very good question. And I think since like November last year, it started to be a little bit different. But, looking at like from 23 up until October, November, the main driver was the momentum factor over all three regions. And even if you look at last year, like our two best performing ETFs were our Canadian momentum ETF and then the international momentum ETF. And some of that obviously is due to the positioning with regards to precious metals. So we had a lot of exposure to some of the metals names in materials, in momentum. The other component also is, it was overweight in sectors that are kind of benefiting from the whole AI CapEx spending, but like not necessarily the ones that are spending the money, but the ones that are receiving the money. So like utilities, some of the industrials names. And so momentum was basically benefiting from a few different trends that weren't necessarily tied together, because the gold trade is more about more central bank buying, a little bit of, uncertainty around the US dollar and other, central banks trying to offload treasuries potentially and using gold as that alternative. Whereas the other one was simply just a growth and investment, like a secular investment trend that we're going to likely continue to see. And so it was very well positioned. And then the other one I'd say has been value more recently. So value is also in that kind of picks and shovels of the AI trade. Like some of the names in our US value ETF, for example, which has been, if I look since inception of FEQT, I'd say FCMO and FCUV, so the US value and US momentum, have been the highest relative contributors. And then that'd be followed by the same two factors, but on the international side. FCUV has been very resilient in a period where value really wasn't the shining star. It was really kind of those mega cap growers, right? Like the Mag 7 story, 23, 24 was the same thing.
With the AI run?
Yeah. So like 23, 24, you had about 30 something % of stocks in the S&P 500 that were outperforming. It was a very narrow group, which is not the ideal environment for a strategy like ours, but we had some very strong stock selection that helped us, because in my mind, when I looked at those 2 years, and I'm going a bit further than your 24 months, but still 23, 24, like momentum, if momentum wasn't there, that was kind of our savior, but value was like basically in line with the benchmark when it probably should have been, you know, a little bit behind. Mm-hmm. And so it exceeded expectations and really allowed us to continue to outperform kind of some of those main passive competitors. But, you know, currently, you know, as we're looking at like this year, just like really more recently quarter, like low vol started to work again, which it hadn't worked in a while, because that's a factor that it's there as an insurance policy. As markets, you know, generally go up over time, right? Like markets tend to go up over the long term. Like it's really there to help protect when things get that you have those kind of black swan events, if you will, like, you know, 2008, 2020, 2022, even to a certain extent it helped, because it's just people run the defense when things are uncertain and you don't have clarity on what's going to work. So that's actually been positive. And even this year, what's really interesting, I mentioned that stat on 30% of stocks in the US were outperforming. This year, it's like 63, I think, percent at the end of the quarter. So it's more broad. More things are working. Financials are working a little bit. You had, industrials starting to, like Caterpillar was one of the top holdings in FCUV. Like nobody thought Caterpillar was going to be, one of the better names in the S&P 500 last year. And so, versus going back a couple years, it was like one or two factors that were outperforming, but thankfully by quite a bit. So it helped. This year, it's like three factors are outperforming in every region. Right. Yeah. Value, momentum, and low vol, with quality kind of being set aside, unfortunately for your favorite factor. But that's a lot of that is due to the exposure to software. Yep. And software names are under pressure from the threat of AI. Like whether ChatGPT or Claude or these other programs being able to replicate a lot of the kind of things that we thought were very hard to replicate in the past. We'll see how that plays out. I'm a little contrarian myself and see a lot of those companies being very, you're basically buying some very high quality companies at much lower valuations. Yeah. And it's going to be interesting to see actually how value reacts, right? And how you guys were mentioning how the factors follow the underlying fundamentals of the market. Mm-hmm. If I look at our Canadian value ETF, in our last rebalancing in February, it went overweight technology in Canada for the first time. In my memory, in the entire index backtest, it was the first time it's been overweight technology. So, what does that say, right? And that's what's interesting about these, right? So it bought, Celestica, it bought CGE, it bought OpenText. And so obviously maybe a bit less of Shopify because that one's actually done a bit better. But and then does US value start to do that next rebalancing? Who knows? So anyways, but those have been the main drivers, I'd say, over the past. And then obviously Bitcoin's contributed over the entirety, but over the last 12, 24 months, it's been a slight detractor to performance.
Yeah. And speaking of Bitcoin, one question was, as the recent Bitcoin drop made Fidelity rethink their 3% allocation to crypto and FEQT?
Yeah, and that goes back to the behavior part. The reason we added it in there is not because we thought it was going to go up necessarily, right? It's because in the sample size that we had, and once again, when you're building out a portfolio and when you're doing your research, like all you can do is rely on the past. Yep. Like you can make assumptions for the future and say like, okay, in this potential environment, if that repeats, how would it behave? But we could only look at like, what has Bitcoin done over the past 7-8 years at the time when we launched them. And what we had found is it was actually additive to the portfolio from a risk-adjusted returns basis. So for those familiar with like the Sharpe ratio, right, you're looking at return for every unit of volatility that you're taking on. Anytime we were adding Bitcoin up until 3%, it was improving the risk-adjusted return. Mm-hmm. And then as soon as we got above 3%, it started to decline. It plateaued and then declined. And so that's the rationale behind the 3%. So anytime it gets below 3%, to us, it's just a time to continue to bring that back close to our target neutral mix. And I think, Régis, your point on, having some exposure, but then not having to manage it directly is, I don't know many, because you said it's polarizing. So the people that like Bitcoin, they own a lot more than 3% of their assets in Bitcoin. And those that don't like it just have 0%. Right. So if you've got 30, 40%, 50% or more of your assets in Bitcoin, you're extremely susceptible to that heightened volatility, which is a volatile asset class, like by all means. And on the flip side, if you're at zero, well, you're never going to benefit from, the continued growth of that space. So I think we're happy with that spot, and we're not reconsidering it right now. The one thing we did consider at one point is because we do have an Ethereum ETF was should we cut cut it in half and give 1.5 to each? And the rationale behind not doing that is once again, history as our benchmark, they tended to correlate very strongly together, right? Like it's pretty rare that you have them going in opposite directions, at least if you look at like monthly periods, 'cause obviously on a daily basis it can happen, but Ethereum, is kind of a bit less, it's a bit smaller market cap, a bit less well known, and we thought for a core portfolio, Bitcoin just made a bit more sense, but it was generally more because they tended to correlate strongly to each other.
That makes sense.
Interesting, yeah.
Nice. I have another Redditor actually had a nice question for you. Actually, he was wondering how to choose between FEQT, which is the all equity all in one, and FGEP, which is the Fidelity Global Equity Plus. And he did a little bit of research, and he saw that FGEP has a little bit higher fee, but actually no Bitcoin exposure. So maybe he was a little bit actually confused. Maybe which one should go? Is actually FGEP the same as FEQT but without Bitcoin, for example?
No, so that's a great question. It's very different, very, very, very different. And FEQT, which we're starting to have covered most of the main points here, is it is factor based, which by definition is like we're actively designing those methodologies and those models, but they're being executed in a passive way, right? It's a recipe that then is being pumped out by Geode, who's our portfolio manager, and with FGEP, it's a combination of 4 active strategies managed by 3 managers, and so that's a fully active mandate. What that means is you're going to get something that's also very dynamic. That the allocations are trying to be core to the neutral mix though as well, though there's no like calls being made of money moving from one manager to another, but you've got in there the same kind of concept of diversification. Where we do it with factors, we're doing it with managers that have very different styles. So we have Daniel Dupont, who's kind of more of low volatility value manager, looking to really capture a lot less of the downside. In his Canadian large cap mandate, which is part of that product, he's never had a negative calendar year, right? You can't do that with a factor. You're fully invested at all times. And so that approach is very complementary to a Mark Schmel, which is also part of the product, who's more of a kind of like a momentum manager. And he's focused on, the 2 different tails of the market where, high expectations, high valuation, stuff that, he sees, growing very rapidly over the next, 5-10 years. And on the flip side, he's also taking advantage of kind of these, companies that are beat up, and maybe there's a turnaround story there as well. And so very complimentary to Dan. And then the last manager would be Hugo Lavallée, who's kind of a contrarian investor, and then kind of he's gonna shift his approach as he sees fit to in the market, but has done an exceptional job of creating alpha, over his tenure. So 3, really great managers that we have at Fidelity. And the idea was if we put them together, people are going to stay invested longer, right? Because if you have only exposure to one of those managers, maybe in certain phases, they're slightly out of favor. And, the body of work of a great manager, you can look at over just like 5, 10, 15 years and not, each calendar year. So with FGEP, the idea is the same. We want core, but we're doing it in a very different way where these are actively managed building blocks. And but the goal is the same. Yeah. Ideally, we both want to be beating those passive competitors, right?
Absolutely. So that's interesting. So FGEP actually in a portfolio could be complementary to FEQT, for example. Because it's a different approach. It's
a different approach, but I will say they're both global in nature. They're both, very diversified. Like, there wouldn't necessarily be a ton of overlap in terms of approach, but the result is going to feel probably slightly similar because they still remain global equity mandate. I'd say FGEP, if anything, would probably be lower beta than FEQT. So probably a little bit more conservative. It also has exposure to so Canadian large caps, one allocation, but there's also exposure to Daniel Dupont's global value long short ETF, that's really been a product that we've seen extremely efficient at managing volatile periods. Like this year, he's up more than 10% as of the end of March. So that's a strategy that has a low, if not negative, correlation to broad equity markets. So I think if you're trying to compare the two for an investor that's kind of a bit more growthy, FEQT is probably the play. And if you're a bit more defensive, focused on downside protection, maybe closer to retirement, like maybe that's something that, that could fit perfectly.
Nice.
Yeah. Another question, how tax efficient is FEQT for Canadian investors, particularly in non-registered accounts?
So that's a very interesting one. And tax is always kind of a hot topic. And it's something probably we don't talk enough about because it is, especially as soon as you go out of, outside. Registered accounts is one thing, like that's, whether it's RSP or TFSA, like it's not a, immediate issue like you would find with, non-registered accounts or open accounts. So we don't have like a, there's not a function or a feature of the product that specifically aims to be tax efficient, right? So it's not like we have, some companies will offer some of their ETFs in a corporate class structure, which is basically they pool all of their products together and then try to offset the expenses and revenues of the funds, and then hopefully, all that should come out is capital gains and Canadian dividends. We do have some income. We do have some other distributions in there that aren't just capital gains or Canadian dividends. So it's not like we're specifically making it the most optimal. That said, we do try and make it as low. We're not aiming for distributions in this product. We're aiming for long-term capital gains. Yep. And so, unlike say some of our dividend ETFs, which are monthly distributions, higher yields, you're probably going to get, more distributions and more income, unless you're buying the Canadian one, which would be Canadian dividend. But there's one thing that helps us, and it's the way that we rebalance. Because we only once a year do a full reset, and that's third Friday of January. So I don't know. Maybe you guys had found that out somehow. But third Friday, January, we aim to rebalance the whole portfolio and go back to that neutral mix. But throughout the year, any inflows we receive, we allocate to the positions that are underweight. And right, so we're constantly trying to fight it back to neutral mix so that at the end of the year, we don't have to sell a bunch of the positions. And so far, we're very, very happy with where we've come in at our tax cost ratio, which is definitely competitive and lower than most peers in the space because of, I think, that approach.
Interesting.
Yeah, yes.
And we touched a little bit on that, actually. How frequently is FEQT rebalanced? And actually, what triggers this? Is there like sometimes it will just trigger rebalancing?
Yeah, so there's one aspect of it of, risk management is definitely number one concern anytime you're thinking about rebalancing too, is like the efficiency of it. So tax standpoint, but also cost standpoint, the MER is one thing, but there's also the trading expense ratio, right? So how much you actually trade the underlyings will impact the total cost of the portfolio, something that investors might not see because it comes out from the return directly. I actually saw, and kind of side note in parentheses, I going on the Reddit and looking, some questions around like, oh, well, is this return's been good, but is that net of fees? The return that you see is always net of fees, right? So I think to alleviate some of that,
but it's a misconception sometimes for most of the people is, the fees are high. Yeah, but the fees,
it's baked in.
All transparent. It's transparent.
Exactly.
So you won't receive actually a bill to pay.
No. Exactly. You're not going to get an invoice at your house. No. So with regards to the rebalancing, we have that once a year set period. We also continually do it, as I was just mentioning. Every day we get inflows, we buy that underweight. If we get outflows, which hopefully we never do, but if we do get outflows, we're going to sell the positions that are overweight, and so vice versa. The other feature that we have in the product is maximum deviations. So if at any given point in time, let's say for FEQT is a bit different because it's all equity. So for FEQT, the only time we would trigger rebalancing is if Bitcoin gets more than its double than its base allocation. So if it gets to 6% because it goes on a absolutely crazy run relative to the other parts of the portfolio, that would trigger a rebalancing, and we would do it the next day. So it's like right away. Okay. On the other one, so like FGRO or FBAL, for those that maybe listening in and use those, we have a 5% deviation on equities and fixed income. So if you have a period like say, and looking at like we kind of stress tested this out obviously before launching the product, it only would have happened 3 times over a 20-year period. So that would have happened in March 2020. We didn't have the product quite yet, but that would have been a period where we would have basically sold bonds to buy back equities, which would have been fantastic because obviously markets rallied well, but that's just, coincidence. But we would have done it in like 2008 as well. We would have also done it back in, the tech bubble. period. But it doesn't happen often, but it's in there to make sure we're not completely off from what we intend, but then also over time in those scenarios, you'd want to be allocating to the asset class that's materially underperformed.
I see.
Yeah.
Nice. I'm not sure if we have time for last question.
Let's do a last question. I think we're getting close to time, and this has been fun. I feel like it's flown by, but
yeah,
maybe we'll have to do another edition and another time. But let's do one last question. That's good.
Last question. So looking ahead 5-10 years, what structural advantages do you believe FEQT has that could lead to persistent outperformance?
I think it goes back to some of the features that we mentioned, is that the beautiful thing about factors is they react to what the market looks like now. Yeah. The issues that can arise with passive investing and market cap weighted indexes is, if you look at like the top 10 today versus the top 10 years ago versus the top 10 20 years ago and 30 years ago and 40 years ago, is pretty much all different companies. And so eventually you have a period where the top 10 is then, moving out of the top 10. Yep. Like for us, because we're rebalancing more frequently and we're reacting on fundamentals, like for example, for quality, if a sector or a company in particular is now all of a sudden, over whether it's their return on invested capital has improved, whether the free cash flow margins have improved, like we're going to capture that before it gets to the top of the index, for example. And so the underlying factors themselves by design are adapting to what's important. Yep. And what's relevant, and momentum's no different as well. And so I think that gives us an edge because we won't have to rethink as much, how we structure the portfolio, because the factors are doing that themselves under the hood. And so I think as an investor in FEQT, you know that it's going to be, dynamic. Mm-hmm. It is going to be very dynamic to changing. If AI just, takes over the world and, it's replacing any SaaS company, well, guess what? It's going to be one captured in momentum. Eventually, it's going to be part of the quality because they're going to be the most profitable business in the world. And so, yeah, there might be a little adjustment period, but it's not going to be the time that it takes for passive to react. It's going to be much quicker. Yep. So I think that structural advantage is what's going to allow us to hopefully maintain
capturing the factor and advance. Yep.
Well, yeah, it's capturing, that over the long, another, wise man, actually Fidelity, man, stocks follow earnings. Mm-hmm. Well, whether that's for quality or whether it's the free cash flow yield metric that we use in value, like it's going to, our factors will react to those fundamentals. And so that advantage does not change because the methodologies are there for the long term.
Right. And I guess we're in 2026 and we hear about in the news about, all those potential IPOs coming during the year from high-tech companies, et cetera. And I guess FEQT, based on the different factor algorithm, will decide if those should be included or not based on characteristics.
But it's going to be based on fundamentals. Once again. So actually that's and I guess we'll wrap up with that. But the interesting thing with IPOs is generally when they do happen, they're not very much value. No. So they don't score very well there. It does happen that they're quality, but that's pretty rare also because they're generally newer companies or companies at least that have been, spending so much to grow that they don't have that much free cash flow. They're pretty volatile.
Yes. Yeah.
And they don't have any momentum because they're brand new. So they don't really score well on factors, right? It takes a bit of time for them to be and so it's kind of like a wait and see approach to your point. But guys, we're going to wrap it up. Thank you so much for your time. And for everybody tuning in, thank you so much. Once again, you can catch this on your favorite podcast app. All our latest our past episodes are there. This was a very unique and fun episode. It flew by. I hope you guys all enjoyed it as much as I did. So thank you, and we'll see you next time.
Thank you.
Thank you.